I'm Joshua Roberts of Biz News, and with me today is Corion Capital Chief Investment Officer David Bacher. Corion publishes an informative summary of asset class and fund performance returns every month, which is suitable for any level of investor. The report can be found on Corion Capital's website or biznews.com. David, let's have a look at 2021 before we look forward. A great year for most asset classes, particularly equities. What are your high level remarks of 2021 and how does it compare to any other regular year in the markets?
Thanks, Justin. I think from our perspective at Corian, the best indication how the man in the street did in terms of investments is generally through his investment through his retirement fund. And a retirement fund is not just about equities, it's a mixture of different asset classes, mostly equities, but it has bonds, it has offshore investments, it has cash, and it has to, because of legislation, it needs to be a diversified portfolio. So we like to look at the high equity space where those unit trusts are for long term retirement funds. And the average return that a high equity unit trust did, and that's over 100 unit trusts, was just over 20%, which considering inflation is about 5, and considering the next best return from that high equity category was in 2006. It was an exceptional year for investors and for people's general wealth to improve.
Which were the best performing high equity funds in 2021?
It's quite an interesting year in that, especially in the South African context, you usually have, almost a bang bust kind of scenario where resources are either shooting the lights out because the rands are weakening and at the expense of maybe financials or vice versa. This year it was very different. The all share index was close to 29% return, and the basic materials did outperform with low 30s percent returns, but financials were up 28%, industrials were up 24%. So it was a case of most major equity sectors rising. So unlike previous years where you look at the best unit trusts, it was generally those who were very heavily weighted in financials or very weighted in basic materials. That wasn't the what happened last year. So, if I looked at the winners, and maybe I'll touch on that a little bit later, I think what did stand out last year was small caps. That the small cap industry, after many years of really lagging, was up over 50%. And I think those funds that didn't have exposure to NASPAS and Process, which is a big weighting in the all share index, NASPAS and Process had a tough year and being a big counter in the market. If you were biased towards small caps and didn't have exposure to NASPAS and Process, you would have had a very good year last year. So, if you look at the best performing funds, it was those funds that really were positioned that way. We're talking about Pit for Yun's Counterpoint, which when I looked at the best performing funds in the various categories, they actually were the top performing in two categories: low equity unit trust and global. So it's very seldom that you get best performers in two very different categories. Walter Aylett and Co. Had a very good year. And those were those funds that were positioned, as I said, biased towards value, small caps, and very little exposure to NASPAS Process.
At the end of the report, Corian publishes its own array of funds performance. The equity mandated funds perform particularly well. What does the investment process look like for the team at Corian?
We've done things a bit differently with our equity fund. Most people, or most companies that follow a multi-management approach, mix different strategies and funds together. What we've done at Corian is actually blend different managers' best ideas, and we've left a large part of the portfolio construction and the risk management to ourselves. And in that way, we're trying to get the best ideas from very clever managers. And fortunately, our managers, such as Andrew Vincent from Clucas Gray, had an exceptional year. A lot of the small caps or less favored stocks of 2020, he invested in at the right time. And that was the reason why Corion as a house was fortunate to have a very, very good year.
We're just over a week into 2022, and we've seen some significant drawdowns in the US, particularly in the tech sector. JSE has held firm predominantly because of the value bias inherent on the local bias. But do you expect more of the same in this growth to value rotation we're seeing at the moment, given that all the economic indicators, inflation, interest rate direction, etc., are pointing towards it?
I think it's going to be a very interesting year. And what was quite defining last year was if you looked at the US Treasuries and the 30-year US Treasuries. Now, US Treasuries and bonds generally are a better indicator what's happening out there than the equity market. If you look at all previous equity markets, bear markets, the bond market tends to be a better indicator. And last week was the worst weekly total return of the 30-year Treasury in almost 50 years. And that's quite striking. It lost about 9%. So, at Corian, that could be a big sign that, the lights are going amber to red at the moment. And it's an indication that, rates are probably going to go a bit quicker, higher than people expected. And this wall of money, which was filled by the Fed, quantitative easing, low interest rates, that's coming to an end. And what happens generally in that kind of environment, the stocks, the momentum stocks, the growth stocks, where you rely on low discount rates and they're generally pricing great expectations going forward, that does struggle. So from a Corian perspective, we're certainly not overweight equities, and we certainly do have a bias towards value kind of shares, not just South Africa and globally, which tend to perform better in that kind of environment.
David, just to back up what you've just said, all the portfolio managers I have chatted to in the last 2 or 3 weeks sort of concur with what you're saying. Is there any way for us to hide as investors? What are the safe havens to look forward to in 2022?
Well, I think you never want to go, all in or all out. Market timing is very difficult. Generally, asset classes rise over time. So if you go too conservative uh, for too long, you generally underperform. So I think don't go get too scared and get totally disinvested. But I do think it's a time to have a bit of your portfolio in more conservative assets. And things like cash is not such a bad investment, because if you have cash and the proverbial rainy day arrives, to invest that at lower prices is always a good thing. So I would just maybe lighten up on equities, have a little bit more cash in your portfolios, and don't get too greedy, because it has been a good period for investors.